You hear me talk about this just about every day where the markets are. So, what are these three indices that are so widely quoted, and what are the differences between them, and how closely should we pay attention to them? Well, here's a brief overview. The Dow was created by Charles Dow in 1896, and it's supposed to serve. It was supposed to serve as a proxy for the broader U.S. economy. So, at the time that it was created, we were in the Industrial Revolution, and our economy was very much industrial. So that's why it's named the industrial average. And it's made up of mostly what we call blue chip stocks, the very large publicly traded companies that trade on the New York Stock Exchange and the NASDAQ. The Dow's composition has changed over time as our economy has changed. So, they're not all industrial stocks anymore. There's technology companies in there and companies that are supposed to represent the broader economy. But we'll get to the pros and cons in just a second. So the second one, the S&P 500, features 500 supposed to be all U.S. publicly traded companies. They tend to break a few of their own rules now. Some of the companies in the S&P 500 are not exactly U.S. companies. And they have the S&P 500 has an emphasis on the way it's calculated on market cap. So market cap is the price per share times the number of shares outstanding. So it has to do with how large or small a company is. The S&P was created in 1957 by the credit rating agency Standard & Poor's. So that's why it's called S&P 500. It's a floating weighted index, meaning that the market cap of the companies in the index are adjusted by the number of shares available for public trading. So because it has 500 stocks instead of 30 stocks in it, it's considered to be a much more deep and diverse way of looking at the market, so to speak, of publicly traded companies. The NASDAQ, the third index that we look at, or the NASDAQ Composite, was created in 1971. It is a market cap weighted index of around 2,500 stocks that are listed for trading on the NASDAQ stock exchange. So 2,500 stocks, even more broad of an index than the S&P 500. So which one do we watch? Well, we talk about all of them just because that's what you hear the most about. So we talk about that. It is a general indication of how the equity markets are going. So what are the criticisms? Well, the Dow obviously only consists of 30 large cap U.S. companies. So it's not really a broad measure of the total market. And it excludes utilities and transportation because they have their own separate indices. And it's price weighted. So this means that the index that's price weighted, higher share prices have a greater influence. So if you think about a stock that is $10 a share and it goes to $20, well, that's a 100% increase. A different stock may have a stock price of 110, and if it goes to 120, that is less than a 10% increase. So even though the percentage move is greater in the first example, it has sort of the same impact on the overall index. I know that's kind of a lot there, but the S&P is a little bit more representative because it has more stocks, 500 versus the Dow's 30, and it's a market cap weighted method. So giving a higher percentage, a higher weighting to companies with the largest market caps, while the Dow is price weighted. So you heard a good bit about the Magnificent Seven last year. Those were the 7 stocks that were responsible for the majority of the positive return in the market. So that's what you get when you have these kind of indices. It's not necessarily representative of every stock that's out there. The NASDAQ is a market cap weighted index, and it means that it is heavily influenced by larger companies. So NASDAQ, remember, includes 2,500 stocks. 50% of the NASDAQ performance is attributed by the top 10 companies. So 2,500 stocks, 10 companies are responsible for 50% of the performance. And then if you look by sector, it's not really representative of what a regular portfolio should be anyway. 55% technology. So how much should you pay attention to the markets? Well, you take it with a grain of salt as a broad measure of how stocks are moving, but not really a good benchmark for a diversified portfolio, which is what we give you with our strategy. So your portfolio should look nothing like any of the market indices that I just mentioned. The indices are a really bad measuring stick for your portfolio, unless you're under 40 and only invest in an index. And if you do biblically responsible investing, it is a really bad benchmark because a good percentage of those are not biblically responsible.